Imagine a future where you can quit your 9 to 5, spend more time with family, or even travel the world, all before the typical retirement age. Sounds dreamy, right? Well, what if I told you that with smart investing, you can turn that dream into reality? And no, I'm not talking about some get-rich-quick scheme. In today's video, I'm going to show you how the Schwab US Dividend Equity ETF, or SCHD, can help you build a passive income stream and potentially retire earlier than you thought possible. Whether you're already investing or just getting started, SCHD could be a game changer in your journey toward financial freedom. So grab a notebook, because I'm breaking down exactly how this ETF works, how it can grow your wealth, and how you can use its dividends to boost your early retirement plan. And don't miss the tax tips at the end to help you keep more of your hard-earned money. Let's kick things off by explaining what SCHD is and why it's an attractive option for long-term investors. SCHD stands for the Schwab US Dividend Equity ETF. In simple terms, it's an exchange-traded fund that pools together stocks from US companies known for consistently paying dividends. SCHD tracks the Dow Jones US Dividend 100 Index, which focuses on high dividend yielding companies with a solid track record of paying dividends. These companies are often stable, well-established, and profitable, which is great news for anyone looking for steady income. Why should you care? Well, as an ETF, SCHD offers several big advantages. 1. Diversification. Instead of investing in a single company, you're spreading your risk across multiple high-quality businesses. This helps protect you from any single company's downturn. Low costs. SCHD's expense ratio is just 0.06%. That's like paying 60 cents a year for every $1,000 you invest. A steal compared to other funds that charge higher fees. Accessibility. You don't need a ton of money to get started. You can buy a share of SCHD just like you would with any other stock, making it accessible to both beginners and seasoned investors. Income and growth potential. Since SCHD focuses on companies that not only pay dividends, but also grow them over time, you get the benefit of both income and long-term capital appreciation. So how does SCHD help you retire early? It's all about that sweet combo of steady dividend income and long-term growth. One of the biggest hurdles for early retirees is generating consistent income once you stop working. That's where SCHD comes in. The fund's focus on high-yield, sustainable dividends provides you with a reliable stream of passive income, even when you're no longer clocking in every day. Here's why this matters. Dividend-paying stocks are often associated with mature, stable companies. These businesses aren't chasing rapid growth. They're focused on steady earnings and rewarding shareholders. And as an investor, you benefit from this stability. Even in tough market conditions, these companies tend to be less volatile than high-growth tech stocks. But it doesn't stop at stability. Many of the companies SCHD invests in also have a history of increasing their dividends over time. This means your passive income can grow, helping you keep up with inflation and rising living costs. Inflation is a real concern, especially over the long term, but with SCHD, the growing dividends can help maintain your purchasing power. For instance, in 2024, SCHD paid out its largest dividend in its 12-year history. Imagine reinvesting those dividends back into the fund. By doing so, you're buying more shares, which increases the amount of dividends you'll receive in the future, setting off a compounding effect that can supercharge your portfolio growth. The idea is simple. Let SCHD do the heavy lifting. Over time, as those dividends keep rolling in, you'll be building a passive income machine that can fund your early retirement. SCHD isn't just about safety, it's about growth too. In 2024, the ETF had a dividend yield of 3.7%, making it an excellent choice for income-focused investors. To put that in perspective, the average dividend yield of the S&P 500 is around 1.5 to 2%. So with SCHD, you're getting almost double the yield of the overall market. But here's the kicker. SCHD has been paying and growing its dividend for 12 consecutive years. That kind of consistency is rare and incredibly valuable for long-term investors. In fact, SCHD recently increased its dividend payout by 24%. That's a massive jump, and it's a testament to the quality of the companies within the fund. Compare this to other popular dividend ETFs. For example, Vanguard Dividend Appreciation ETF, VIG, is geared more toward dividend growth, but tends to have a lower yield. On the flip side, iShares Core High Dividend ETF, HDV, focuses on high yields but doesn't offer the same level of dividend growth. SCHD strikes a perfect balance between yield and growth, making it an attractive option for anyone looking to retire early. Another great thing about SCHD's dividend growth is that it helps offset inflation. As the cost of living rises, so does your dividend income. That means your investments aren't just sitting there, they're actively growing, and in many cases, outpacing inflation. If you thought SCHD's dividend yield was impressive, wait until you see what happens when you reinvest those dividends. Reinvesting dividends is like adding fuel to a fire. It makes your money grow faster through the power of compounding. Let's break it down. When you receive dividends from SCHD, you have two options: pocket the cash or reinvest it. If you choose to reinvest, you use that dividend income to buy more shares of SCHD. As you accumulate more shares, you increase the amount of dividends you'll earn in the future. This creates a snowball effect. Each new share earns its own dividends, which are then reinvested to buy even more shares. Over time, your investment starts to grow exponentially without you doing anything extra. To make this process even easier, many brokerages offer a dividend reinvestment plan, DREP, which automatically reinvests your dividends into additional shares of SCHD. This eliminates the need to manually reinvest, so your portfolio grows on autopilot. Here's a quick example. Let's say you're 30 years old and decide to invest $900 a month into SCHD. If you continue this for 25 years, earning an average annual return of 9%, your portfolio could grow to nearly $900,000 by the time you're 55. And with SCHD's current dividend yield of 3.7%, you'd be earning about $30,870 in passive income each year, more than enough to cover a significant portion of your living expenses in retirement. By reinvesting those dividends along the way, you're speeding up the compounding process, ensuring that your investment grows larger and your passive income gets stronger. That's the magic of long-term investing. If you are interested in finding about more ETFs that can add growth up to your portfolio, linked above the screen is a video on the 7 top monthly dividend ETFs that could outperform S&P 500. Let's talk about taxes. No one likes them, but they're important to consider when planning your financial future. Fortunately, SCHD comes with some great tax advantages, especially if you play your cards right. First, most of the dividends paid by SCHD are qualified dividends. This is important because qualified dividends are taxed at a lower rate than regular income. Depending on your tax bracket, you could pay as little as 0% or as much as 20% in taxes on these dividends, compared to ordinary income rates, which can be much higher. For 2024, 100% of SCHD's dividends were qualified, making this ETF a tax-friendly option for dividend investors. That's a huge bonus, especially for high earners who want to keep more of their passive income. However, if you're holding SCHD in a taxable brokerage account, you'll need to pay taxes on those dividends each year. But here's a strategy. If you hold SCHD in a tax-advantaged account like a Roth IRA or 401k, your dividends will grow tax-free. That means you can reinvest and grow your wealth without worrying about Uncle Sam taking a bite out of your earnings. Even if you're holding SCHD in a traditional IRA or 401k, you won't pay taxes until you start withdrawing the money in retirement. This tax deferral can be a powerful tool for accelerating your portfolio growth. We've covered a lot today: SCHD's low costs, steady dividend yield, and its incredible power to help you retire early. By investing in SCHD and reinvesting those dividends, you're building a passive income machine that grows with time, protects you from market volatility, and helps you keep pace with inflation. Whether you're looking for a safe, reliable source of income in retirement, or you're on a mission to retire early, SCHD is a fantastic tool to add to your portfolio. If you found this video helpful, hit the thumbs up and subscribe for more tips on building wealth and achieving financial freedom. And don't forget, Your financial future is waiting. Let me know in the comments if you have any questions about SCHD, and I'll be happy to answer them. Catch you in the next video.